Hello everyone, I'm Astrid Daniela Galvez. As a fellow business owner, I'm passionate about helping other small businesses succeed. That's why I've partnered with QuickBooks on this video series to guide you through some basic business fundamentals. In this video, we'll unravel the mysteries of financial statements and help you assess how your business profits. If you're more of a reader, check out the link in the description. Before we get to the bottom line, give this video a thumbs up and subscribe to the QuickBooks channel. It's an excellent source for more informative videos just like this one. A financial statement, it's like a health check for your business. It gives a good picture of whether you're making profit or heading toward trouble. That's why you should pay close attention to what these statements tell you about your business. So what makes up the business's financial statement? Basically, there are three parts: the balance sheet, the income statement, sometimes called the profit and loss statement, and the cash flow statement. These three items are significant because they give a picture of your business's financial performance. They show your business's economic resources and obligations, along with its earning capacity and potential cash flows. Most importantly, a financial statement gives you the information you need to make smarter business decisions. Let's look at the three elements that make up the financial statements, starting with the balance sheet. The balance sheet highlights the assets of your business. These include the value of inventory, vehicles and equipment, as well as intangible assets such as copyrights and trademarks. Counter to that are your liabilities. This is the money your company may owe to suppliers or debt such as bank loans. The difference between the two is known as the business's equity or net worth. Next, we have the income statement. The income statement shows the business's revenue and expenses for a period of time. More importantly, the income statement indicates if your business is making profit, breaking even, or losing money. Here, the expense of creating a product or service is deducted from the revenue earned. The difference is known as the net profit. And the third element is the cash flow statement. This statement is often overlooked, but it's crucial for your business. It shows all the cash flowing into your business as revenue and all the cash flowing out as expenses. The cash balance at the end of the accounting period will equal that on the balance sheet. Reading your financial statements carefully can help you flag potential problems early on so you can fix them. It's a good idea to keep an eye out for a rising debt-to-equity ratio. Over 100% is cause for a concern because it indicates that your business is taking more debt than it can handle. Also, if you see a decline in revenue, you may need to think about cutting costs. Beware of large expenses hidden in the other liabilities on the balance sheet. Other indicates that the expense isn't significant enough to be broken into its own line, and it should be reserved for small expenses. Don't forget, when using QuickBooks, you can find all of your financial statements in the Reports section. Now, you can consider mental math and multiple spreadsheets a thing of the past. If you found this video helpful, don't forget to hit that like button and subscribe to the QuickBooks channel for more content like this. Now, keep calm and finance on.